Hi, everyone. Welcome to YX Insights. Today is May 9th, pre-market. We're going to just talk briefly about the FOMC and our model signals that are released daily. And then we're going to jump straight into the price action technical analysis for SPY, QQQ, TLT, Bitcoin, and the Max 7 stocks. All right, let's begin. So on Wednesday, we had another FOMC. Nothing really happened. Essentially, the market sees 4 cuts in the next 12 months, and that didn't really change from before to after the FOMC. And the message from Powell is very clear. He doesn't think the economy is really slowing. The Q1 GDP came in smaller, came in slightly negative, but that's mostly due to the fluctuation in the net exports. And the assumption is that the businesses are trying to front run the tariffs. So that could be a one-off timing impact. But excluding the net exports, the economic growth is still robust. Unemployment rate of 4.2% is still very low, and inflation is moving towards the Fed's targets. In this fairly benign backdrop of economic environment, the Fed doesn't see the need to act until they have further clarity on the impact of tariffs. The impact of the tariffs, of course, could be potentially inflationary. That could be a one-off inflationary impact, or it could be more sustained. It could weaken economic growth. The Fed did highlight that the risk of unemployment going up has risen. But it's still too early for the Fed to tell. That means June is also not going to be a month for the Fed to cut. And now the market really sees July being the first real opportunity for the Fed to act. But potentially it could be even later into September. And of course, the market has basically been screaming, the Fed has been late again, and the forward indicators or the soft data like consumer sentiment has been pointing negatively. Business surveys showing the businesses are very concerned about the macroeconomic picture and uncertainty, and that has a negative impact on investments as well as spending and hiring. Essentially, the Fed doesn't want to act until it sees solid data being presented in front of it. And in that case, even if the economy drops off a cliff suddenly, the Fed can cut in 50 basis point, 100 basis point chunks. So I think it's preferring a wait and see and then cut large if it needs to sort of approach rather than 25 basis point incrementals that the market normally sees. So really nothing from the Fed in the foreseeable future. I think they will pause QT at some point soon, probably late summer, as the bank reserves will start to wear thin. But I think the Fed is trying to stay out of the political and economic involvement from this point. Looking at our YX signals today, so this is the last row, we have 0 for Tesla. So that's the first 0 in a while. We had 1 0 before, but it became 1 straight away the day after. So we had a new 0 this time, meaning the model thinks investors should sell Tesla and park in cash, and that's been successful. More successful than buy and hold in the historical backtest. For QQQ, we have another string of 1 since launch, so risk still largely on. And for Bitcoin, again, we've had 1 since every single day since our launch. And that's been really helpful in capturing the entire rally from 79K to today's 103K. And I think most technical traders, including myself, would have been really wary of the resistance zone around 96K. It tried pushing above it for more than a week and couldn't succeed until 2 days ago. So, and a lot of us could have probably taken profit too early. So, but the model, if we follow the model, and the strategy, we would have captured even more upside than selling at 96K. Apple, again, risk on today. So position is 1. So the model had a quick 1 day travel down to 0. And that's the day Apple actually said they're going to explore AI options in search, which basically tanked Google by something like 9%. So that was right. So we're actually outpacing buy and hold because of this 1-0. And the risk was back on yesterday, and stocks rallied across board yesterday, which was actually in line with our signals. And we're back. We're still holding today for Apple. Amazon, we had a 1 yesterday, but it's flashed 0 today. So that's quite interesting. Of course, it's hard for me to explain why machine learning models are showing 1 or 0 on any given day, because they're just trying to really pick up pattern recognition from the training set. So it's picked something up from the latest development from yesterday. But we'll be interested to see how Amazon closes. Microsoft, even though after big earnings pop, the model still insists on risk on every single day, and the stock has been going up, even though in much smaller steps after the earnings. So that has been correct. And TLT, we're holding cash again. We're on the sidelines. And the model essentially has helped us avoid a string of consecutive down days in the past week. And that's been extremely helpful in bond trading. So overall, I think today is still risk on, but as you can see, we having a couple of zeros already shows that the momentum is probably slowing in the stock market. So this is looking at SPY versus dollar yen spot. And the caveat is that dollar yen spot is being pushed forward by 10 days. So the SPY data lags the dollar yen data by 10 trading days. What we observe is that there is a leading impact from the dollar yen to the stock market. And the thing is really we shouldn't really be interpreting this in terms of magnitudes. I think it's more helpful to think about it in directional side. So when I say, for example, you can see that in terms of the movement, this SPY and dollar yen with a 10-day lag has basically been moving lockstep. But over here, SPY dropped much further after the dip in dollar yen. And then SPY has traveled up, but on a daily level, there is still quite a strong correlation in terms of direction, and dollar yen bottomed over here, and it's now moving up. So I think overall that should bode well for risk asset in the next 2 weeks, even though we are seeing a slowing momentum and SPY is trying to push above 200-day moving average. So overall, I think it does. The risk sentiment is still largely on based on this chart, but we're going to go through all of the individual charts as well. And I just want to go into bonds as well first. So in terms of bonds, actually, oil has been a quite large explanatory factor in bonds. And we see that when oil prices are high, there's a higher inflationary pressure. And of course, high inflation means yields will stay high to combat inflation. And that translates to bonds going down, bonds being cheaper. So we see this negative relationship between oil and bonds, which in this case, TLT. So we have seen oils rallying off this bottom in the past few days, in the past week. And that has put further pressure on TLT moving down and yields going higher. So I think we've established So after those two things moving down together in this period, in the early April period, where investors are dumping bonds and they worry about economic backdrop, and therefore the oil demand and oil also came down with a potential supply pump from OPEC plus from this month onwards, but also further out. We've established essentially a new trading range here. And this new trading range, again, we're looking at directional moves, and I wouldn't want to extrapolate too much on the magnitudes. This new trading range means that oil could be rallying here, and that could pressure bonds further down. And bonds could be breaking a new low if we see a more sustained rally from oil. Oil doesn't need to be getting back to this point in the mid-70s for bonds to go further down. It just needs to rally from the current point. So I wouldn't extrapolate and say, okay, bonds will only go down if oil goes to 70 or 80. It doesn't really work like that. It's really about rebasing the new normal baselines as the past data have already been processed and reflecting the market mood. So now looking at SPY itself, it has been trading a very tight range in the 555 area to essentially 570. And that's just under the 200-day moving average, which is the orange line here. And you can see that a large volume was built up here that became the resistance. And it also now is further accumulating over here. And why we are looking at the volume here is that when the price moves up to this point in this green box region specifically, a lot of people who bought the dip over here back in March are now break even, and they effectively become suppliers in size because they were suffering a lot of pain here. They're trying to ride it out, and now they're break even. That's kind of psychologically relieved their pain, and they want to just get out, hit the button, and get out. So it was quite. I did expect the market to kind of like run into resistance in this region just because of the supply being of the people who bought from here. But now it's as it moves sideways and actually consolidate in this region, that's quite constructive because if the market is actually bearish leaning with all the supplies hitting the bid button in this region, where you wouldn't have actually seen SPY traveling back down, retest this trend line again, it still could. But the fact that it spent the past week or so in volume testing and consolidating in this region kind of does bode well for us to move, challenge the 200-day and the move towards our wave 3 target. So actually my primary expectation is for SPY to move over this trend, move over the moving average, 200-day moving average, and try to challenge this in the near term rather than retest. But of course, you can never rule out anything for this retest as well. So primarily still bullish, and with the alternative expectation that if it breaks down this region, we could see the retest straight away. QQQ. QQQ is more bullish than SPY because first is, again, we had a big volume in this area in the 470 and the 490 region from the dip buyers here. You can see the volumes are quite large in this area. And but still, the price didn't turn down once hitting this zone. It's actually consolidated sideways and is really ready to challenge a 200-day moving average here. And I do think the near term, we should get above this and move towards the wave 3 target, which is the 138% extension of wave 1 from the wave 2 low. So that's 527 level plus. So that is my near-term expectation. And plus, there's a lot of volume that's been built just under this 480 area. You can see over here. And that provides a source of support because when it travels back here, that's where a lot of people have re-entered the market as well, buying from those sellers and re-enter the market. That volume serves well as a break-even demand. People thinking, okay, I can add some position here because the overall market is still bullish and the tariffs, all that stuff are coming closer to the agreement. So I do think near term again, QQQ is looking quite bullish, moving towards 527 area. And now to the 30-year yield. And I look at the 30-year yield first because TLT is essentially 20-year plus treasury holding. So the tenors align more closely with the 30-year yield rather than the 10-year yield. Otherwise, we're looking at duration mismatch. And the 30-year yield bond is more liquid than the 20-year bond. So you can often see a kink in the yield curve where the 20-year yield is higher because there's less demand, because it's a newer product. So institutions use the 10-year and 30-year a lot more often for hedging and duration matching than the 20-year. And what we see here is that we had an intraday high on April the 9th, which then sort of close. That's quite close to this 5% high the 11th as well. And to me, all of this signals the bias towards the upside. And if we really look at this chart, this is a quite bullish chart for yields. I'm using quotation marks because in bond terms, yields higher usually is equivalent to bearish because bond prices go down or sell-offs. So here, I'm just talking about the yield. So this looks very biased to the upside for yields and bearish for bond prices, which is TLT. So I do think we'll challenge this 5% mark again. I think the setup is there where it's making a bull flag over here, traveling and it's pushing towards the upper side of this channel. I do think we will test this 5%. And once we do test it, the next level up is 5.5 really as the next target. And I think 5.5 is potentially the minimum we get to for the long end yield. Why is it moving so high? So a couple of things. The Fed is not as dovish as the market hopes to be. So four cuts for the next 12 months is not really a sign of market anticipating a full-on recession. I would say economic moderation, yes. Meeting the Fed inflation target, yes. And then adjusting back towards the neutral level, the theoretical neutral level, which is around 3.5%, yes. But recession, which would require 150 basis point, 100 basis point cuts in each meeting, and then getting us down to 0 to 1% range in the Fed funds. So that would be the recessionary pricing, and we haven't seen that yet. So the market doesn't actually think we are entering a recession after Q2. So that's the first thing. The second thing is there is a rising term premium in the long end bonds. And the term premium essentially is the extra yield investors demand for holding long duration bonds. This is because there's a greater risk of government default if you're holding a 30-year bond versus a 5-year bond. And that premium has been rising. It's been around 50 basis points after the inauguration, essentially. And it's been rising because, first, the market isn't really convinced that Doge could substantially reduce the budget deficit or the government spending, generally speaking. So there is still a worry of this supply risk in the long end, especially once debt ceiling issue is resolved into the summer. So the government could issue a lot more 10, 20, 30-year bonds, and there's less demand for it. And there's less demand because the Fed has stepped back. The Fed is still formerly in QT. I have seen on Twitter that people are saying, "Oh, the Fed is buying the 10-year note again," right? But that's just keeping its balance sheet in line with the pace of reduction. So if more than enough bonds or MBS have expired, they would renew those tenors by buying treasuries to keep the balance sheet at the same reduction pace as they plan to. So really, that's neutral in terms of liquidity. So unless the Fed is willing to signal they're commencing QE, i.e., buying additional bonds and expanding its balance sheet as a primary buyer, as a large buyer of US Treasuries, I think investors are still a bit worried about the supply risk of the government spending, and essentially the bank reserves are also wearing thin. So the private buyers are not as cash rich as if you had the Fed coming in. So I think so the yield curve has been steepening, which means yields on the longer end have gone up and the shorter end come down. And that is essentially this symptom of we're expecting rate cuts in the front end, and people are unwilling to buy bonds or actually selling bonds in the long end. So now if we look at TLT, and it's essentially it should be the mirror image of the 30-year bond. So I am expecting TLT to make a new low essentially and challenge this region, which it has held since October 2023. So I do think we will challenge this region in the mid-80s and actually potentially break below 80. Now moving on to Bitcoin. Bitcoin has been very bullish. It did get quite stuck around the 96K level. You can see that for 2 weeks is trying to get past 97K and really struggled. But we did accumulate a lot of institutional inflow in the ETFs for Bitcoin. For IBIT, which is the BlackRock Bitcoin ETF, there was an inflow of more than $4 billion since mid-April. So that actually has helped Bitcoin breaking above 100K yesterday and now making a new high, which means that my previous expectation of this being a B wave is now invalidated. And I'm actually really excited that it was invalidated. I was very worried that we had 1, 2, 3, 4, 5 waves down, and then for 1, 2, 3 ABC wave up, and that could be the end of the first bounce, and we're looking at a much larger correction after. But breaking above this range and over the 138% extension of wave 1 is very constructive. And actually, I have revised the chart so that I do think this region was very ambiguous, whether there was a 3, 4, 5 in the small circles, or whether this was actually wave 5 over here and we had a wave A. The trouble was that wave C here is much larger than wave A in terms of the extension, but it happens in commodities crypto a lot more often, where the absolute Fibonacci levels don't always go according to the theory. So actually, it's become a lot more clear that we had wave 3 completing here, and this is expanded flat, meaning wave B was above wave 5 of 3, and then wave C is below wave A. So now this chart begins to tie up. We are able to more confidently project forward on what the next move could be. And I do think we can, of course, get past 1.618 to 1.76 extension in this wave 3 versus wave 1. But I do think most of the big rally is kind of behind us, and we are due a retrace probably down to the 95K level. There's room for 92K, but I think 95K is probably the most sensible support level where a lot of this volume it has been accumulated and serves as people who are now trying to buy the dip again, thinking actually this region was quite good, then buy the dip and aim for a new all-time high. And I do think we could potentially get past this all-time high in this wave 5. So I do, and like I said, the model signals, this YXI strategy signal has really helped us staying in the trade and capturing all of this upside from the 79K level. Now looking at Apple, I do think we could have potentially bottomed in wave 2. If it hasn't, and if it breaks below this wave 2 here, then we are probably looking at slightly further dip, and we can see this is expanded flat for wave 2, wave A, B, and C. And that does feel a lot more unlikely. Let me just draw this in red. As an alternative. So that could be the case if we break through wave 2. But I think as long as this wave 2 low holds, we're looking at wave 3 next. And I think wave 3 standard is essentially 1.38 extension of wave 1 from the bottom of wave 2 or more. It can be as low as 1.236 extension, which is 226, which is just above this 200-day moving average, but it wouldn't be as reliable. The reason being that is often a sign of ABC corrective move because of the lack of extension in this rally. So in short, I expect Apple to reach 230 in the next move, and my primary expectation is still bullish. Amazon is approaching its 200-day moving average again, there has been significant volume built into this area, 170 and 190. Why is this important? It's extremely important that a lot of this is a sign of accumulation, and once we get past the 200 EMA, the stock could really just take off to 225 level without any sort of retrace. Because you can see that not many people actually have traded in this 200 to 225 region. So there's not that much pressure in selling. And once it breaks above this, risk is on, and people are probably going to be chasing the Amazon stock here. I think Bezos has filed to sell something like $6 billion, which can be quite easily absorbed by the daily volume, essentially. And I'm not too worried because he's already stepped down as the CEO for many years now, and he's essentially trying to enjoy life, put money into his space work, Blue Origin, and other stuff, and just trying to spend it all before he dies, essentially. I don't fault him. Because what's the point of getting money if you're not going to spend it, or if you're not going to help other people spend it, like your favorite charities or your people you care about? So Bezos in a spending mood is really not of concern, in my opinion, unless he lists $100 billion of sales overnight, which is half of his net worth. Then okay, that could be a bit more resistance in terms of the way they execute the trade. Every time it gets to 200, they will start selling again, type of thing. It could take a few more days to digest, but fundamentally, I'm quite bullish for Amazon in terms of growth. In terms of AWS, I think it's at least 20% undervalued because the current valuation would be entirely justified by AWS alone, and you're getting the retail side essentially for free. So yeah, so I do think Amazon is a bullish stock, both fundamentally and technically. Looking at Google, the ABC chart pattern has not yet been broken. This large red candle with heavy volume was essentially thanks to Apple exploring AI options. Apple sends a lot of traffic to Google because Google search is its default browser search. But to be honest, since the rise of ChatGPT and AI chatbots, it's become more prevalent today for people to use it than maybe even a year ago. A year ago, ChatGPT was this fancy new tool. I wouldn't say a year ago, maybe 2 years ago was a fancy new tool, but actually it's not as prevalently used as people who are in the tech world or or in the investing world where they're really aware of those type of trends. But now I think everyone is using it. Essentially, it's a top app, or all of the AI chatbots are top apps on the App Store, and it just saves a lot of time. The problem, so I used to run an app, I still do, but as an app business, and one of the requirements to do keyword search engine optimization, where you are filling your articles with a lot of filler words just to promote certain keywords like health and fitness. So when people type in health and fitness apps, yours would go up top. Or you could pay Apple or Google a ridiculous amount of money for the App Store search or the Google search results to be top ranked when people type those keywords. But now, if I'm just chatting with ChatGPT, I answer directly, I actually get a definitive answer, or at least if I want a few options, and I can get AI to advise me, etc., on what I want. It really saves me time trying to go through 10 different websites, looking at 2,000 word articles, just trying to determine a simple fact. So I do think it's inevitable that search gets eroded over time. So the Apple news was really just another indicator of this search erosion. It's not really a game changer. It was going to come sooner or later. The best thing Google can do is trying to get Apple to use Gemini in its search. But then Apple has agreements with ChatGPT, which is half owned by Microsoft. So Google could be losing its competitive advantage over there as well. So all of these things is why it still trades a very modest PE multiple in the mid-teens, and investors are still very cautious. It's actually landed right here at the trend line as a retest. So for now, the read is still bullish, correctively bullish, because I still see this as an ABC zone here after 5 wave down. And we could be turning down once we hit the 200 day moving average. This count hasn't been invalidated. If we move below wave B here, then it's potentially we could be potentially looking at wave C having topped already prematurely at the 90% retrace extension of wave A. But such is the live market. Nothing will ever be completely identical to theory anyway. Meta, we have a pretty bullish chart above the 200-day moving average, above the trend line, and with very little retrace on this way up. A lot of volume being exchanged over here in this very tight region of 585 to 605. So that's a lot of people buying from the sellers who got stuck back in March again. And the fact that it's remained above 200-day moving average for a week is pretty constructive. What I really want to see is we do get some sort of retrace of this wave, and we can get wave 2 entry looking at this wave 5 target of 880. And this wave 5 target is very simple. It's just the inverse 138% extension of this wave 4 from the wave 3 high. And that's typically where wave 5 could end. And of course, our path of mapping this, it will become more precise once we get a bit more data in the near term. Microsoft, I do think we had a pretty good win here, because back here, I did call for a bottom, wave 5 bottom. I did say that this was a flat structure moving into April, and it's taken over a year or around a year to complete. And we could be looking at a five-wave setup from this region here, and earnings, even though I think it's pretty much the same as previous quarter, pretty much the same thing, has brought us back to the 430 level, which is actually where we traded pre-earnings in January, essentially. So we did a round trip, and you could, in non-Elliott wave technical land, you could call this gap here versus this gap here being a long island, meaning this entire movement here, it has been isolated from the main body of the move, and this is quite bullish breakout. It doesn't have to fill. It means the bears have been abandoned and bulls are looking for the next move up. What I do think, though, is it does warrant a near-term retrace. I cannot tell you the exact timing of this retrace, but it has moved enough for wave 3 to be deemed complete or sufficient in length, and wave 4 could be anywhere between the 23% to 38% retrace of this wave 3, and that would actually land us quite nicely at this 200-day moving average and this large volume zone over here as support. NVDA, I do think the chart is getting quite bullish here. I'll count this as 1, 2, and then 1, 2 setup. Now moving into wave 3, of course, it had to break above this trend line and then the 200-day moving average. So it has a bit of work to do. There's a lot of volume in this region here from 107 to 120. It's actually quite a tight 20% region. But once we get past this trend line, I think off to the races, moving towards 130. I do think we can get a new all-time high this year. And actually, just looking at this wave 4 structure, it's very similar to Microsoft, even though Microsoft didn't make a new high back here. What we see is this is an expanded flat where wave A is shorter than wave C, and wave B is higher than wave 3, where we started. And that is a very trappy setup for the bulls, including myself back here. Actually, this was a B, C, wave B move rather than the 1, 2, 3. And once it broke down, we're really looking at the 5 waves down for wave C here. So that has been a very difficult pattern to decipher in real time. With the benefit of hindsight, obviously our vision is 2020 in hindsight. I think now we are ready to tackle wave 5 here. And Tesla's had a really early start in this bottoming process, trying to move up towards the 200-day moving average, and then eventually had a double bottom here, which I do think is a wave 5 bottom for this wave A, and now we're challenging for wave B into the 350 plus region. Right now, it's really just consolidating in a very narrow range here under the 200-day moving average. You can see a lot of volume is building in the 270 to 290 region, which is very supportive of the next rally when it breaks out. One thing I do think has on its side is the global money supply factor that's working very well for Bitcoin. Essentially, with a 3-month lag, the Tesla stock follows the broad direction of the G5 M2 money supply, and the G5 being US, UK, EU, China, and Japan. And that has been expanding rapidly since January due to 2 reasons. First, the local M2 levels have just been going up in those countries, but secondly, dollar has been weaker, so it translates to a higher dollar amount in terms of the money supply. And that has a positive effect. You can see that the bottoming process for Tesla coincided with the bottom of the M2 supply in January, and the next leg up should be higher. And just going back to my Tesla chart, is there a chance that Tesla just moves directly to a new high without any sort of wave B resistance? Absolutely, because if you look at the Bitcoin correlation, Bitcoin follows very tightly with the M2 supply as well. Bottom around the same time, peaked around the same time, bottom around the same time, and now it's making a new high following this G5 M2 minus supply, and it's invalidated our wave B expectation. So yes, there's a chance that Tesla does make a new high too following this chart, but we just need more evidence before we extrapolate too much from the correlations. So that's it for today. Thank you for viewing. Any questions, please let me know in the comments.